Hey everybody, what's up? We are back with another stock analysis. So today we are looking at Canadian National Railway. So they are very, very simple railways in Canada. Now, I don't know too much about the company, so let's just get right into it. Before we start, make sure to subscribe. I do these videos basically every single day of the week, all types of companies, whatever you want. Make sure to comment below any companies you want reviewed, and let's get into the video. So, starting off with National Railway, obviously transportation, business, supply chain services, networking, rail, trucking, also, which is interesting, and many, many other things. They offer their services to a very, very wide range of industries. So, one thing I want to point out is they are projecting to have increased revenue per ton miles, which obviously is a good um, metric for them. Volume growth is expected to grow in the last quarter of 2024 as well as into 2025. Revenue per unit is expected to actually decline this quarter but grow slightly into the next year. Operating ratio, I honestly don't know what this means, but I'm assuming higher is better, and it looks like it'll be increasing in 2025 as well, at least compared to this quarter where it took a slight decline. But anyway, this is a $63 billion company, something to consider, fairly large. So, 2.4% dividend yield. That's just about middle of the road. For this company specifically, it's probably average for the industry. Another thing, target price is at 120. Long-term growth rate is just over 7%. Current price is at 101, so that is fairly solid. Let's get into the growth summary, and we can see here positive across the board. Now, obviously not massively positive, but one thing to again remember is this is a railroad company primarily, so shouldn't be expecting massive amounts of growth here. I would say if you were interested in putting this stock in your portfolio, it would be stability, the dividend, which is fairly okay for a dividend, and steady growth. So overall, not the sexiest company, but at the same time, it is definitely something that would be in a solid portfolio. So that is something to think about. There are, of course, one named competitor, which is this one. I usually don't get into the competitors too much, but I just think that's interesting. There's one. But anyway, let's get into the financials and see what's going on. So, starting off with their income statement, you can see they are projected to be at all time high revenue, most likely within a year or two, just based on where their growth is. They hit it in 2022, which I'm assuming is mainly coming from increased shipping prices following COVID. However, now they are still getting back into their status quo, and I'd imagine they will probably be back up to that level fairly shortly. But looking into some of their deeper cuts here, we could see net income looks fairly stable. It's actually higher than it was in 2022, even with more sales. So that is huge for the company. Increased better margins is fantastic. So that's definitely something to take into consideration there. In terms of their EPS, it looks about the same. It is higher than it was in 2022, most likely because of massive amounts of share repurchases, which you can see right here going from basically 712 about 5 years ago to 628 in 2024, which is fantastic. So overall, looks really, really good for the income statement. So let's get into the balance sheet, see what's going on here. I really love seeing companies that reduce their own shares. It is great for investors, it's great for the company, everything fantastic about share reduction. So this is one thing I was worried about, just with the company being a railroad, is they have a ton of long-term debt. As you can see right here, 12 billion in long-term debt, almost 2 billion in short-term, and they have 700 million in cash. So that is massively a problem. It isn't really the end of the world, just considering how much equity they have. Their debt to equity isn't too bad, but it could possibly be in the future. And at the same time, they're going to have to put significant resources towards paying off this debt now instead of growing the company. So hopefully everything that they are using this debt for, which I'm assuming just based on their asset increases in the past few years, I'm guessing that they have been greatly investing in the company, which obviously they should, but overall, hopefully this translates into more profitability going down the road in the future. And we'll have to see how that ends up. But overall, I mean, assets are increasing steadily. They're at an all-time high, obviously now. Was a slight dip in 2022, but we can actually go into the quarters here and see how they've been doing in 2024 specifically. So we can see just got over 40 billion in assets, which is good, although cash is looking very, very low compared to the past 2 years. And actually, it looks like debt is still increasing. It seems like every quarter they're adding a couple hundred million in long-term debt. So that is not fantastic. Short-term debt was reduced slightly, but over the past 2 quarters, but overall does not look great for the debt situation. So going into the cash flows, I'm expecting these to be very, very healthy. And we can see here funds from operations are basically entirely the operating cash flow. CapEx isn't anything too crazy. They are cash flow positive. So again, everything else doesn't matter too much. But main things to take into consideration here, the change in capital stock, always negative across the board. That is fantastic. However, they are issuing a ton of debt every quarter, as you can see right here, and that is not great. It does look like they have been reducing it over the past 2 quarters, but I mean, that could just be how things go for the company. It could be a seasonality thing where they don't need as much money, but overall, should be interesting to see what happens with that in the next few years. Hopefully, they start reducing debt. Going into their segment history, I can kind of show how their sales have been growing over time. And it does show that dip in 2023. However, 2024 is supposed to surpass this significantly. But overall, you can see there is a bit of seasonality year to year with this company where they experience a few years of decline and then a few years of fairly significant growth afterwards. It has happened multiple times in the past. So overall, this isn't anything too unexpected, and they should most likely be at record sales within a year. So no big deal there. Heading back to the ratios, their ratios have been improving fairly well. So their gross margin is slightly above their 5 year average, which again, their average is very, very steady and actually higher than it used to be, despite their sales being increased so much, which is fantastic. Operating margin is above average, net margin is above average. And again, they do have that better net margin. If we go into the quarters here, we can see that their net margin is better than it was in 2022 with 31 here compared to 29, 30, 33 is a little bit higher, but on average in 2022, we had 31, 32, almost 33. So overall, higher despite less sales. They made more money in 2024 and 2023 despite having slightly less sales. So that is very, very good to see. And again, the consistency with their margins are very impressive. You could also see again, ROA, ROE are just about on average with every other year. That is fantastic. Usually companies grow for a few years with really, really high ROE and then fall off. And the fact that this company has been so steady with their growth is very, very impressive. You almost never see that. But overall, getting into the debt ratio, like we talked about earlier, their debt is steadily increasing with their long term debt to total equity. I'd imagine this will most likely be at a level that is above 100% within a year or two, unless they reverse their course. Now, usually I go off of the 80% or lower rule, which is basically if it's lower than 80%, it's all right. That's fairly healthy. If it's above that, could be in trouble. If it's above 100%, that essentially means that they would have to liquidate all their equity to pay off their debt, which obviously in most cases does not happen. And we have seen debt to equities being much higher than 100%, and the company is perfectly fine. But overall, this should be reduced from where it is now. So anyway, going past their financials, we'll head into their earnings reports recently and kind of see what has been in the recent news for the company. So, moving in here, we can see some metrics. And first off, it looks like their overall freight revenue came in slightly under estimates. Petroleum and chemicals beating here, metals and minerals falling short fairly significantly, almost 20 million short, which is most likely where the most of the miss came from. Looks like forest products increased, coal slight decrease, grain and fertilizers increased. Intermodal again significantly under by just almost 30 million, and then another 10 million miss from automotive. So overall, they are seeing some weakness in some of their sectors, but others are kind of picking up, but miss the estimates altogether. And then in terms of their other revenue, they did beat fairly significantly with almost 20 million. Carloads decreased by 2% compared to a 0.8 estimate. Revenue increased 4%, which is almost double the estimate. Operating ratio was just about 0.5% above the estimate, which is good. And then free cash flow came in 3 million over their estimate, which is very good to see. Any beat in free cash flow is usually perceived as being very positive, which it is. And let's get into some analyst reviews here, and we could see kind of where they are looking. So a bit of a mixed amount here. So on one hand, one lowered the price target from 181 to 178, which isn't crazy, and also significantly higher still than the current price. Upgrades to a buy for this one to a 160 target price. This analyst upgraded as well. Maintains outperform rating and 180 target price, and it maintains outperform rating and 179 target price. So overall, their target price is significantly higher than the company is at now, which if we go back here, we could see they're just over $100. So definitely perceived as being significantly undervalued, which is really good. Some key points to take away from this: in line with expectations, but confirms results were impacted by strikes and wildfires. So, again, that is a risk for their company, especially in Canada, where they have been seeing a lot of wildfires in the past few years. That definitely affects them significantly when they most rails have to travel through remote areas. Sometimes maintenance is very difficult. So that is definitely a significant thing for the company. Other than that, strong grain values, also contract wins for their intermodal unit, which is solid. Overall economic weakness, railway was still able to grow, which again, we have been seeing that with their very, very steady growth in a lot of different things, as well as their maintaining their margins. So that is very positive. But overall, I think this is a mostly positive review. The company looks really solid. And now let's get into their chart. So, looking at their chart over the past year, you could see they have essentially only declined over the past 9 months or so. Looking like a recent low, they've basically only been declining for the past probably month, with no interruption at all. So, the stock could be due for a localized bounce. However, one other thing to look at is that there is a support line here that has been hit significantly in the past after other drops and is now completely broken. So this $103 range, as well as there is the psychological boundary of $100, which it does not look like they broke yet, which is good. It actually looks like they bounced off of it in the past day. I don't think they went under. We can actually see they did go under. If you look at the top of the screen here, $99.90 was the low on Friday. So that could possibly break. Just considering a lot of people consider $100 to be kind of a psychological boundary, where when people see that 99, they're like, oh, it's way cheaper, and they buy, and usually it's a very strong support. However, it could possibly not be as much of a support. You could see it has in the past right here been a support for them. And if we draw this line across as well, you can see that, where although it is slightly above, the area itself has been very heavily support driven. So overall, I think that they can recover from where they are now, given the fact that that earnings report was fairly positive. I do believe they're most likely just gathering some value, kind of coiling the stock price here towards possibly a higher move. But overall, they have been very strongly trending down. I don't think it will be too soon that we'll be seeing any kind of new highs in this company unless they do some kind of big changes. But just based on this, I really am a little bit more pessimistic, only because I was expecting, based on that last earnings report that we went through, for it to be very positive, and considering it wasn't, that definitely could mean there's a lot of negative investor sentiment on the company. Obviously, railroads aren't exactly the future, which I think a lot of people fully understand. However, in a place like Canada that is so remote, most of the country is incredibly spread out. I think it is very relevant for them. But right now, we are looking at them being towards the bottom of a channel. As well as this, you can see, based on the indicators I have here, that they are towards a very significant bottom on both of these, which I won't get into too much detail on these indicators because I don't use them too much. But they are on a fairly significant bottom there. So that could be showing support. If we go to a more long-term chart, we can kind of see that they have essentially only trended up for a very, very long time now. This is over the past essentially 10 years, actually more like 12 years, but they have been in a very strong uptrend for a long time. I'm not expecting anything too crazy to happen to the company. um, their all-time high is right around 135, and honestly, I think that is very achievable within the next year or two, as well as just continuing up further. Um, it does kind of seem like they're finding support here. However, again, considering they broke through these last two lows, it's just something that you'll have to monitor closely, which I may do another update on the company fairly soon just to see where they have gone. But until then, that is all I have. Make sure to subscribe if you haven't. I make videos like this every single day of the week. So if you're interested, hit that subscribe button. That's all I have. Thanks for watching, and I will see everybody in the next video.